General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.
Hello there, listeners, and welcome to this week's edition of Bulls versus Bears. It is Jonathan Takadeni here from MPC Markets, and we have Kai Chen.
Guys, glad to be back.
Okay, nice. Yeah, so our fearless leader, Mark Gardner's out in his boat again. Not a great day. I mean, it hasn't been great sailing weather, but Mark's just decided to get on the yacht anyway. So
he's working on the yacht, though. He's he's working hard on the yacht.
That's it. So either way, big week in the markets this week. Just to recap, Mark was bearish. I was bearish. I believe we were both like 3-star bears, and officially the S&P was down for the week. So we both were right. And it is episode 93. So first of all, we'll start off with the media. I believe we were both on the call this week there, Kai. So I was on with Michael Wayne from Mediating Finance on Tuesday, I believe. And who you were on with? Howard, wasn't it?
Howard Coleman, that's right. So we had we had a battle of the time frames. I think we're on the much shorter time frame from under a year. Howard's definitely investing in the 15 to 20 year time range. So very different perspectives. Yeah.
Okay, well, there you go. That's what makes a market, that people, while they have, people might agree with, overall it's a good company, but, people have short-term reasons, and that's what makes a market, and that's what drives it. So I was on with Michael Wayne. If anyone listened to it, I don't know why, but I decided to call everything a picks and shovels play of whatever industry they're in. So I called Data 3 the picks and shovels of IT. I called, was it Orica, which is obviously picks and shovels. It's explosives of mining. Duratec, I called that the picks and shovels of defense as well. But yeah, just overall, look, ASX names, there were a few good names. One that kind of stuck out that Michael Wayne was quite bullish on was Global Development Group, GDG. That's kind of just snuck under my radar. And after I dug a little bit deeper, it made a lot more sense. So if you have a look at Challenger Financial, basically that's gone on a tear for maybe the last 6 months. We held it, but we didn't hold it for that move. For clients, we missed out. And what that is basically their annuity business is starting to take off with a lot more people retiring, people looking for fixed interest. And GDG is actually a player in that space as well. They also acquired Lonsec and a funds management, and they have a funds management arm. So basically, it's kind of like a Hub24 or a Net Wealth. If you're in that space, there's plenty more money coming in, and it's doing well. So how about yourself, Kai? How was the call for yourself?
It was very good. I think a couple of the stocks that we both agreed on. Basically, funny. Well, actually, that was one. Sorry, I'll start off with the one that we disagreed on: Liontown and PLS. So I think obviously if you're a long-term wealth investor, these lithium stocks are a little bit different to what you're used to. But it was actually really something that was insightful was basically he said that lithium was the third most common commodity, and it's interesting because that's definitely one aspect of it. But I think also another one is how easy it is to refine. But it's very interesting because with these life cycles where at the moment obviously the lithium price is still fairly low. All the miners who are inefficient, they have to close down or can't continue to operate. But there's probably a shorter cycle because, as the price goes up, more and more of these mines switch back on. And, you get this thing, but it's not a rare resource, which is something that I didn't actually read into. But it's quite interesting. So yeah, that's something I learned.
Yeah, well, it is. It's what you call a bulk commodity.
Yeah.
I remember the first lithium boom. So I've been I've been in this market for a while, and basically the first lithium boom was probably around, from memory, around 10, 12 years ago. Like,
Mm.
yeah, that's how long I've been in it. And so the funny thing about Australia is that whatever the hot commodity is, we have it. Like, it's just, so I remember we had the lithium boom, and then there was the graphite boom, and then there was the rare earth booms, and now we're having the gold and silver boom. It's like, oh, we have it. We even have a tier one deposit in platinum and those precious metals group. In Chalice, which is actually in Perth as well. So it's like whatever metals we need, Australia tends to have. I won't go on to the whole. We mismanaged the whole thing, but either way, it's there. And just back to lithium, if this boom does come about, I think it'll be the fourth boom within that space. And I often say that the ASX has the memory of a goldfish, meaning that it because we're abundant in all different types of minerals. It's basically once you move on to the hot mineral or the hot sort of sector at the time, you have your boom, you have your bust, and then we move on to the next hot thing. And so lithium looks like we're having a resurgence there. And one thing with the lithium, even though it is quite common, it's all about having grades that are quite commercial as well. So that's what's happened is, when they were exploring for it, they're like, oh well, we found so much here, and what they were doing was they were factoring a price of look, I'm just pulling the numbers out of the thin air, but call it say $20,000 for what a ton of spodumene or something along those lines. What's actually happened is, in the most recent pullback, that price got cratered, and from memory, it fell by about 70-80%. So imagine, you're doing your modeling, you're doing your DFS, you're penciling in a spodumene price of say X, and then as as the mine's getting built, and then now you're producing. You're like, here we go, time to reap the rewards, and then that price is X minus 70%, and you're like, yeah, that's why you have to shutter mines, and that's why like even companies that were multi-billion-dollar market caps got absolutely decimated, and there's a lot of there's a lot of people that will they know about these lithium booms and busts, but then there'll be a lot of people that are like they're too gun shy now, and they might miss out on this whatever this this rally provides. So yeah, that's my little take on sort of lithium. So front
There was
cover.
sorry, there was two more other tech stocks just to mention
Okay, yeah,
before we
yeah.
move on. That it was interesting actually. Like we haven't really got an opportunity from those in quite a while, right? So like RIA, as well as Zero. So
Mm-hmm.
we always when we look at the charts we go, oh, it's like too expensive. It's on a massive run. But both of them actually have come off quite a bit, and they are in that value range. And I know, JT, it's the old pain trade, right? And it's like I think the trick is not to buy it at the moment, but they definitely come on the watch list, right? Because and it's in my opinion, it's like they should go onto the watch list, and we wait for momentum to turn, and then get on these because in the long run, they're still solid companies, right? Like I mean,
Mm-hmm.
RIA is still a monopoly in the Australian real estate market. And Zero, I mean, zero, it's everyone uses it. The base is so high, right? So,
Yeah. Well, the thing is, you've started to focus a little bit more on, say, testing strategies, and
mm,
I'm with you on that. It's great to see that things are getting cheap. The main problem is that I'd rather be on something expensive, getting more expensive, meaning that I'd rather be on something that has upward momentum in the share price. And I think as we go, as our business matures and we can allocate resources to filtering out those situations, yeah, like absolutely, I think we'll be able to bring more value to clients as we get on those sort of value companies. but not have to waste time, hoping and praying. Let's
Yes.
let's wait till they turn around. Cool. Okay, so front cover of the Bulls versus Bears is rate cuts and reality. So what that basically means is we've seen it here in Australia a lot more clearly in that, when the RBA cut, what was it, a month ago, everyone was kind of waiting for, okay, well, they're pricing in more rate cuts into the future. I think they were pricing two more, so they were definitely pricing one here 2 weeks ago on Melbourne Cup. And then they were pricing one in next month as well. And then what's happened since then is a week ago we had strong inflation. So that came in at, I think they were looking for 2 and it came in at 3. So a massive beat. And obviously the RBA is like, hey, that's well past our sort of band for inflation. And then just just yesterday, we've had a strong jobs numbers as well. So I didn't see the actual number, but I saw it on the top line. 40,000 jobs were created as well, which beat estimates. And then so the markets, even though they were pricing in rate cuts, basically the reality is the economy is not as weak as the market is screaming for. Basically, I think what this is, Kai, and you'll probably agree with me, is that everyone just got used to cheap money.
Oh no, they're everyone's addicted to rates, right? I mean, like any pretty much any situation, the solution is a rate cut. So
Yeah,
if the market's going well, rate cut to go
yeah.
higher. If the market's not doing well, more rate cuts.
Exactly.
Um,
They just want rate cuts. It's
yeah,
like we've gone through a period where I remember when people were fixing their, I think 2 and 3 year mortgages at like under twos, like 1 point something, and you're like, whoa, that is free money in essence. And then now they're like, oh, you got any more of that free money? We like those lower rates, and unfortunately, and it's not my fault. It's the bond vigilantes. Basically, they've worked out that, look, if we're going to lend money to the governments, we want at least a rate of return well above inflation. And that's why you're not seeing these bond yields drop. So even though we saw the RBA cut rates, the bond yields haven't budged, and they're still, it depends on which duration you're looking at, but some of them are still around those 4 levels. So yeah, that'll be an interesting one. So next page. Dun, dun, dun. Oh, one sec. Okay, so this is the equity market all around the world. What I would like to highlight is basically the US markets. If you haven't just looked at the US markets, it's actually all been in the last couple of days. It was actually bouncing along quite nicely. And then what's happened is there's actually a lot more narrative on the AI bubble. So meaning that, there's all these sky high valuations. You got all these AI companies saying, yeah. So we're gonna spend $1 trillion on the build out, and we're starting to see cracks in that narrative, meaning that people are going, okay. So, as an example, Sam Altman from OpenAI, he's committing to spend $1.4 trillion. That's with a T. The total revenue that OpenAI gets is 13 billion. So for some reason, he's going to spend 70 times more than the revenue of his company on infrastructure. So I'm not saying that that's a bad idea, but it's just more like how are you going to fund that? So it's like me saying, yeah, okay, I'm going to buy a house in Point Piper, and then they look at basically how much how much I earn. You're like, yeah, that would be an interesting one to pull off. And
not his money. He's getting other people's money. Stop
but that's the thing. Like, so so someone actually asked him on the podcast, like, so great, so that's a great idea. How are you actually going to fund it? And straight away he shut the interview down and said, oh, listen, if you doubt it, sell your shares. Like, he was an actual shareholder asking questions, and he just shut it down and interview over. And that's kind of like, hang on, like you can. That's a legitimate question. You can just say, oh, look, I'll go into the markets. There's still a lot of investor appetite for this new sort of new technology. There's plenty of money in private equity now. Just come up with something a little bit more concrete rather than, oh, if you don't like it, sell your shares. That's that's a real. It's kind of like a kid's argument type of thing. So either way, that's what he came out with. But overall, ASX is leading the world lower. Obviously, we had the employment numbers. So if you have a look at the chart, the XGO has broken a few key levels, and even this afternoon as we speak. So we're talking. It's not nearly 4 p.m. on a Friday afternoon, and our index is down about 1.5 today. So yeah, looking kind of weak, and that'll be a fairly weak close overall. One thing I've noticed is that most of the other indices around Asia actually look a lot more bullish than the XJO, but the US ones, except for the Dow, actually look kind of strong. So, I asked Mark this question, Kai. So, just a bit of trivia: what's the largest component out of the Dow 30? What
I already
company?
know.
You already know.
I already know the answer.
Okay. Oh, then just say it.
Is it Nvidia?
No.
No. Is it Microsoft?
No.
It's not a tech stock.
No, it's not.
Goldman.
There you go. There you go.
Yeah.
So the funny thing about tradition and innovation is that there's a lot of things that things are done because that's the way it's always been done. So the Dow Jones is actually a price weighted index. So because Goldman Sachs is $800 a share, it's more valuable on the index in terms of weighting than say Nvidia, which is call it $140 a share. So even though Nvidia is a much larger company than Goldman Sachs, because Goldman Sachs pushed that to new highs, that's what actually caused the Dow Jones to crack new highs this week. So there you go, a bit of trivia for you. Price weighted index.
So I guess the moral story is don't do share splits.
Yeah,
Like that's
exactly right. So that's all it is. So that's why. So here in Australia, we actually love companies that are pennies. Like companies that are 20 cents, 40 cents, 50 cents, whatever it is. Now, as soon as what's Pro Medicus, like $300 a share, people just freak out. Whereas in America, you're like, what's this $10 a share? What's that? Like, oh, I can't do that. Like, oh, $1,000 a share. Yeah, that must be a good company. So that's why they actually play it that way. And it's just interesting the psychology behind that. So there you go. That's my little rant for the equities. In terms of ASX highlights for the week, I think the biggest one for me was good old DroneShield. So so CEO Oleg Vornik, which Mark interviewed, was it maybe 2-3 weeks ago, or maybe a month ago? So we got that podcast there. Oleg sold all of his DroneShield shares early this week, $49 million worth himself. And then two other executives sold out, one with $5 million, another with 12. And they basically said, okay, well, let's cash out because we think maybe the company's overvalued here. So yeah, a lot of insider selling, and I think at one stage DroneShield was trading around the $6 mark, and it's from memory $2.30 today. So wow, so that's the big news on the ASX for me. Do you have any input into that, Kai?
Yeah, I think at $6 it's hard to really justify with any fundamental reality other than speculative hype. But I mean, like at the end of the day, like I am positive drone defense.
Mm-hmm.
The long-term thematic, I do think there is technology and some value in this kind of technology against counter drones, right? But I mean, yeah, just the contract sizes that they're winning, the revenue that they will bring in compared to the market valuation is just like you can't justify that. It's you'd be a fool not to take some profit up there, or
Yeah, and
yeah.
from what I was reading as well, it looks like there was a lot of insider selling in previous years as well. So it's not like this is a one-off, but for them to actually just take all their chips off the table in one go, yeah, pretty dramatic, and that's why the actual share price has been punished. So there you go. That's ASX. So here you go, S&P for the week. Yeah, so obviously, yeah, you see the big one there for me, Tesla. So Tesla's pulled back below that 420 level, so pretty key levels for me. Nvidia down for the week, Broadcom as well, and Eli Lilly absolutely on the tear. So it's like for me, there's a lot of rotation out of expensive names. So I had Live 360 on the call, and I was talking about AMD and Palantir the week before. Um, so the phrase that I like to talk about is in the bull market, all news is bullish. So Live 360 came out with, if you read the headlines, revenue number of beats, subscriber increases, like actual fundamental increases in the company, but the share price got sold off quite heavily on that day and continued to sell off 2 days after that. And what that kind of shows me is that, and you can see it in the S&P map, is that it looks like money's rotating a little bit out of the expensive names, and we all know which ones are expensive, and it looks like it's rotating into value, and so that's why you see even say Berkshire Hathaway getting a bit of a bid there, Eli Lilly, a lot of those healthcare names getting a bid there.
I think, in general, that healthcare sector has done spectacularly well. Like we were just looking at the IXJ ETF the other day, and it's, even before this sector rotation, it's had a bit of, it's been so undervalued over the last year and a half. Basically, all the money is going to AI, to tech, and into the financial sector. The healthcare sector's been pretty battered, right? So I mean, I'm not surprised it's kind of made a little bit of a move on the upside, and especially exactly right, like that rotation, the traditional rotation from risk on sectors into risk off, which is healthcare, a bit of utilities as well, more so in inflationary period, because we did a correlation study a while ago, in terms of like, for certain economic indicators, which sector actually performs the best. And it's fairly intuitive, right? Because like when you have basically risk off, these healthcare ones do really, really well. When it's inflationary, the utilities and the real estate sectors end up doing fairly well. Financials do okay as well. And then, obviously in these bull markets, these tech and growth sectors do really well. So, it's something to watch out for, because if you think that the economic cycle is changing, you can position yourself in a way from a portfolio standpoint, to be more geared towards taking advantage of that rotation. So yeah.
Yep. Okay. Well, I guess that's the probably encouraging thing for this market at the moment. So it looks like there's some rotation, but it's not a case of rotation and just going straight to cash. You know what I mean? Like it looks like the money's still going into the market. So for the bulls out there, it just means that while we could see some choppy action in the indices, it looks like the money's not, say, just totally leaving the markets. And so there you go. Commodities and FX, that's sort of my thing. Uh, Silver, so that's the key there. Silver made new highs this week. So, I was getting a lot of talk or questions from clients like, is this gold bull run over? And my reply to that is no. The underlying fundamentals are still there. The reason why I like the trade is that basically it looks like the governments have to print. They can't keep spending under control, and so that means that money has to go somewhere, and it is going into precious metals. And then obviously, you still have the central banks buying there. So silver made a new high, gold has not made a new high, and lithium prices are through the roof as well. So yeah, they're the three main commodities on fire. And do you have anything to add there, Kai, or do you have
Well,
a?
the Bitcoin one is a more interesting asset class as well, because
Mhm.
I mean, traditionally you think of Bitcoins as a store of value. That's kind of the reasons why they were created. But over the course of time, it's actually become a risk asset, and what it means is, when we do see equities selling off, there's a very high correlation between Bitcoins and and the traditional equity market. So, if you get panic, Bitcoin's actually, the crypto space actually sells off. Um, so it's interesting, because it's actually behaving very different to what the intention of that asset class is. And I don't know I don't know, a bit of voodoo magic as well, where you guys called it, where it's what's 18 month after the halving. There's
Yeah.
a big sell off.
So just to reiterate what that meant, so shout out to Finn, newest member here at MPC. He's actually a crypto veteran. So he's been in crypto as long as me, but the thing is he's stuck in the space a lot longer. So what it means is that there's a halving cycle within Bitcoin, and it happens every 4 years. It's actually written into the code. And what happens is that after every halving, for that 18 months after the halving, Bitcoin usually rallies. Okay. Problem is, after that happens, Bitcoin crashes pretty much. And I'll use the word crash because those dips are quite savage. And we're talking 80%, 70 to 80% dips. And what Finn highlighted to me is like, hang on, did you know about the 4 year cycle? And he goes, and I said, yeah, absolutely. When is it finishing? He goes, it's finished. So what that means is the peak that we saw, 126, maybe 3 weeks ago, thereabouts on Bitcoin, that should have been the peak for this run. And so what that means is for the next 18 months, if the cycle repeats, we should see lower prices on Bitcoin. And the thing about crypto that I sort of knew straight away is that it's all the hype, the religious fervor of Bitcoiners or crypto people in general. I just knew people are going to take advantage of that, and it was there's easy money to be made there. Like so, the way I see it now is that, and I wish I had a Bitcoin implied volatility chart, and I talked about this on LinkedIn, and I made a few posts. Is that Bitcoin on its own, in terms of implied volatility, it used to be 120, 150 vol asset. And now, over the last, say, 3 or 4 years, it's been bled dry in terms of volatility. And
I think
now,
I think explain a little bit in terms of what implied volatility.
so
Rep-
it just means how much it moves. So
yes.
how how much it moves like up and down. Okay, so how volatile an asset is. So I'll give you an example. So property is not as volatile as say the share market, and so the mathematicians assign a number to that. And what I'm saying is like so Bitcoin, you know, 8 years ago it used to trade at 120 to 150 volt. That's what I'm looking. So what that means in terms of mathematics is that within, I believe you got to divide it by 16, so it can move 10% each day. Okay, that's the rough vol calculations I was taught.
And
Now
and
it's
then one key distinction with implied versus realized. So it's forward looking. So implied means that we're predicting how volatile this asset will be.
Mhm.
Realized is what's happened in the past. So
Yeah.
that's the key distinction.
Okay, so fair enough, and I will clarify as well. So I'm talking realized vol has actually been sucked dry as well. So if you look back to where Bitcoin was, it was trading at 2 or 3 times the level of volatility on where it is now. And what that means to me is that you have to be a lot more patient with Bitcoin now. And if you know any crypto people, they are not patient. and so what that means is that they are used to getting 10 baggers, 100 baggers in a very, very short space of time. And so what that means is that because your attention span is so short, like if the asset that you're used to isn't moving anymore, you kind of just give up and then move on to something else. So I think that's what's happening in the Bitcoin space. And I've had a chat to Finn about this. And he totally agrees with me. And what it just means is that Bitcoin's growing up. If you want the instos on board, they want to have a more stable asset on their books. If that's what you want. But the thing is, when they see opportunities like that to sort of test the patience of traders, they will do that because there's plenty of edge in that. So that's my little rant for Bitcoin there and the commodities. But either way, the key number is 100,000, and as we're talking, Bitcoin's trading under that. And what that means is that there will be a lot of people going, "Hang on, where's my Lambo?" So a lot of people are like, oh, putting their SMSFs and just putting money into Bitcoin as a store of value, and it's not trading like a store of value. That's why, I say gold's more of a store of value because it's actually going up with the inflation and money. But it looks like the people that were uh, sort of stomping on gold and keeping the price low, and any gold bugs out there know what I'm talking about, and gold's been like that for years. Uh, the people that were doing that to gold have now moved onto crypto. And that's my little rant. So, next page. Aha, trade of the week. So, we've actually got two trade of the week. So, uh, for the people that are actually on Kai's Mosaic, which is, I always call it Kai's because he's the one that actually developed it, they would have got an email or sort of a notification on their app. This was it Wednesday morning that I sent this out? Yeah, but so Broken Hill Mines is the stock code. Just a bit of a backstory. Broken Hill Mines is the actual original mine that BHP got its name from. Okay, so BHP is Broken Hill Proprietary, so that's what the actual code from, and this is the mine that they actually started off with, and it's actually over the years, been an absolute gem that BHP made their fortune off, and sort of the back of the company. It's changed hands over the years, and then now with extra technology, now what they're doing is there's still plenty of the ore body left, and it's an actual silver producer. So meaning that they're actually producing silver and actually trying to expand the ore body as well. They actually did a cap raise at $1. So you can actually buy in at lower than the recent cap raise. I believe it was 40 million raised at $1. And so with the silver price running higher, we think, and the lows being sort of here around that 75 cents, if you can get in under 90, you're risking maybe about 20% there, and we think that it goes back to recent highs there. So that's a trade of the week, and I'll let you do the trade of the week too, Kai, which is the S&P by the dip.
So this is what we're kind of talking about, and sorry, when we're talking to clients at the moment, there's fear, right? Because people get it. The market is very frothy at the moment. We're at all-time highs, and at some point, reality has to meet expectation. And as we know, I mean, there's a lot of long-term prospect for AI and the tech, and I think it is a revolutionary technology. But look, the valuations for what it is now is very high, so people are a bit scared. So being long at the market is actually quite scary. But we all also know, like, if it actually ends up going higher, there's a chance that we miss out on the up move, right? So, in order to do the best to capture that, what we do is called something called buy the dip, and all this means is within the 6 month period. So, if we go into this trade now, from now to next May, um, whatever is the lowest closing day price, you will get that as the reference price to where the product goes. And this product is about four times leverage. Call it four times leverage, roughly. And what it means is, if you invest $23,000, you can lose this $23,000, but that is the maximum you will lose. If the index goes up from the reference point $23, you will make your money back. And everything above that, every percentage point above that is four times. So that's how the trade works. And the rationale behind it is basically, we've tested this, and historically, whenever it goes into a drawdown period, right, it goes down about, on average, call it 20%.
Mm-hmm.
So if we do hit one of these periods, and there's a lot of indicators that we looked at which might be the cause of that, for example, the December employment figures or the possible government shutdown in January, because they still haven't resolved all those issues, right? And that there's a lot on the table. So I think within that next 6 month period, there's a high likelihood that the market will correct itself. And if it goes, anywhere near that traditional average, like 15 or 20%, what it means is actually you're getting that price, right? This one was actually brought up by Mr. Mark Gardner. So the story and the rationale is we believe that Trump, um, there's a change over in terms of who the Fed chair is in next May. So there's a high likelihood that Trump will nominate a very dovish Fed president,
Hmm.
chairman. So of course, what are the governments going to
I
do?
I think it's more than a high chance that he's going to put
Really?
someone.
It's almost a
It's
certain.
exactly like Trump. There's no way Trump's going to put a hawk in there. Like
Yes.
he wants to control the Fed, so that's why Mark put in there. He's going to take control of the Fed, and what's he going to do? He's going to print baby print basically. Yeah,
What can the central banks do?
yeah,
They
exactly right.
print money. So I think it's this is kind of what what we're thinking. I mean, it could be a different catalyst. We don't have a crystal ball completely on the market, and again, this is what our thesis is. But I think we all understand that it's fairly overvalued at the moment, right?
Hmm.
So it's a nice way to play it, where your risk on the downside is limited. So whatever you put in, and I think the minimum you can put in is about 11 grand, if I'm not wrong.
So yeah, so the minimum is 50,000 exposure or
Yes.
11,500. So they're the rough numbers. We'll get the final numbers soon. But
Yep.
basically, so you can just see in that diagram there, this is a 2-year investment. Yes, you can exit early, after that initial period. But basically, you will get the lowest point for the first 6 months. Okay. And the great thing is that on the exit, you get the average of the last 3 months as well. And as Kai said, highly leveraged, 4 to 1 on your investment. But the great is that you will get the lowest point over the next six months. So if we do have some sort of weakness in December or January, February, April, even till pretty much the start of May, you get that lowest point as your reference, and basically you want the markets to rip from that point. And if we get say that dip that we had in April, like which is what we had this year, that will be certainly ideal because the market fell. What was it, like 20% from the lows? 20% from the highs, and then now with 30% from the lows there. So that would be an ideal situation. So we're not saying that this guaranteed to happen, but there's a chance that it could happen, and this is a trade that can take advantage of that. So just want to preface that this is for wholesale investors only. So you do have to qualify, but it's kind of one of the ways that we're looking at providing value for clients. This is kind of our outlook, and this is a way of, rather than having to watch the market day by day, you're going to get the lowest point within the next 6 months. After that, basically, it's off to the races, and we think that's generally what the market's been doing. Any dips being bought, basically, it's as you said, buy the S&P dip. All right, thanks for that. And so with that, oh, hang on. So let's finish off there, Kai. So basically, we are still in extreme fear. Yeah, and interesting that I think it's still the same level as it was last week. So with that, Kai, are you bullish or bearish for next week?
Oh, I'm probably a four-star bull. Oh, sorry, four-star bear. Um, I'm actually quite surprised that like these levels has come into extreme fear already. So I'm a little bit surprised by where the gauge is. But
Mm.
yeah, I think it's right. Like it does feel pretty frothy at the moment and a bit fearful.
Yeah, and that's where I agree with you. Is that like it's if you have a look at the chart S&P, it's like we pulled back nothing. You know what I mean? Like,
Mm,
it's still in
yeah.
an uptrend. We haven't seen a new lower low, but we're already on extreme fear. And I think what that
Mm,
means is this market's super long. Basically,
mm.
everyone's all in. The insider selling's at all-time highs. Retail's bought the stocks off them, and so everyone's like, "We need this thing to go higher," and it hasn't. Anytime it doesn't make a new high every day, people start to get a little bit worried. So yeah, interesting that we have that. So with that, I'm actually bearish as well. So I was a 3-star bear last week, and I think we'll have. I'm not predicting massive pullbacks, but I just think that another week of lower prices, maybe 1 or 2% lower. Just to suck the bullishness out of the market. So with that, hang on. So Kai's baby, Mosaic, we're offering a free trial to anyone that wants, to experience the product. Basically, all of our content will be pushed through Mosaic. All of our trade recs will be pushed through that. So, you'll get your ASX Alpha, which I run. You get your Global Alpha, which is run by Richard. Eventually, when Finn comes out with some crypto, it'll be through there. High conviction picks and all of our content. So this podcast will be pushed out through that, and then obviously our morning and afternoon reports as well. So sign up for a free trial.
And this week, I'm just going to, sorry, before you finish, I'm going to spruik a little bit on terms of the new features that's just been released. And we thought, we've been looking at it a long time and thought we'd actually put out a proper track record, right? So I think a lot of the clients want to know in terms of what the actual results for the alpha portfolios are. And it's been pretty stellar this year, right? So we internally keep track of it, right? But the issue is that most of the time the clients, you're getting the recommendations and you can't put it into a holistic picture or getting the recommendation size. The whole point is making it a bit more visible so you can actually follow it in a chronological order and you know exactly what we're recommending. And the end result we got to for the ASX Alpha since January is about 42%. Taking into account the size of the trades. And the global alpha has been about close to 30%. It's only been really active, the global alpha, since around April, May. So it's had a little bit of shorter time, but roughly they've actually performed about the same annualized, right? So both very, very good performance. And I think, anyone who is considering a recommendation service, it should give them a little bit more confidence in terms of the holistic picture and how it looks.
Oh, great. That's a great plug there. And with that, I think, hang on, let's just double check. That's the last slide here. So thank you for listening, everybody here. And you guys have a great weekend.
Thanks, guys.
All right, cool.
Okay,
Oh,
done.